from our studios in Atlanta, this is CBT News. And here now, Bridget Fitzpatrick.
Hello everyone and welcome to the Kerrigan Advisors Market Update. Today we're joined by founder and managing director of Kerrigan Advisors, Erin Kerrigan. Thank you so much for joining us today, Erin.
Thanks for having me, Bridget. Hope that everyone on the line is doing well and staying healthy and safe.
We saw that you just released your first quarter 2020 Blue Sky Report. How did the buy-sell market perform in Q1?
Well, not surprising probably to anyone listening, the buy-sell market did decline 9% in the first quarter. And this was really too bad because actually coming into the new year, we had very high expectations for a record first quarter 2020 buy-sell market. Of course, with the termination of Asbury's acquisition of Park Place dealerships, that really put a damper on the entire quarter, but certainly that was driven by this unexpected pandemic that we are all now having to deal with today.
So overall, the market was down slightly. How about multi-dealership transactions?
Well, multi-dealership transactions were a bright spot of the first quarter. We actually saw 15 get completed. That's about 30% of the total transactions completed in the first quarter of 2020. And that's up from 2019 when we saw 26% of the transactions completed were multi-dealership. This is consistent with a trend that we've talked a lot about at Kerrigan Advisors, and that is that we are seeing the larger groups get larger and the smaller groups decide in many cases to sell. In fact, if you look back at the stats, you'll see that dealership groups with 5 or fewer dealerships have been on the decline in terms of the percentage of dealership groups out there since 2010, whereas dealership groups with 5 or more dealerships have actually increased over 70%. So this is definitely a trend we expect to continue, and if anything, the pandemic may have accelerated the consolidation and the growing size of larger dealership groups as scale becomes so important, particularly as the retailing process becomes more digital.
What are Kerrigan Advisors' expectations for the buy-sell market for the remainder of 2020?
So for the remainder of 2020, we think the buy-sell market's going to certainly improve, but the second quarter is going to be the worst quarter, unfortunately, probably since we started tracking this data. And that's because transactions that were in the works are either being postponed, they're potentially being under renegotiation, and we are seeing that as well, or being terminated. So the second quarter, which was the quarter most impacted by COVID-19, we expect to be a very, very slow quarter in buy-sell activity. But we do see some improvements going into the second half. As stay-at-home orders are lifted, we think you're going to see those transactions that were postponed, many of them will close in the second half, and some of the ones that are under renegotiation will also close in the second half. It is our sincere hope that by the fourth quarter, you really do see a tremendous amount of buy-sell activity as we see very much an improvement in sales and buyers getting more bullish on making acquisitions and growing coming out of this pandemic.
How are dealerships performing financially, and how is that impacting dealership valuation?
So it's not surprising to know that dealerships have had a financial challenge starting in March. We like to say this was really financial whiplash for auto retail, this pandemic, because January and February of 2020, we saw the average dealership's earnings up 38% compared to 2019. And to give you a sense, that was tracking back to peak levels of industry earnings back in 2015. So here we came into this year so optimistic about potentially record earnings, and then March hit, and March saw the average dealership's earnings decline 65% as compared to February. I will say, though, that we very much think this is a blip. In other words, we are seeing dealers really cut expenses, become much more efficient in the way they're retailing. So even if sales do not come back to pre-COVID levels in the near term, we think earnings could come back much more quickly. And therefore, as it relates to valuation, we have not found any dealers willing to sell based on the earnings that they're going to achieve in the March, April, May, June timeframe, because those earnings are really not a reflection of future earnings expectations for those dealerships, and therefore really are not a reflection of the value of those dealerships. Certainly there will be distressed transactions, but those transactions are not emblematic of industry valuation. We consider those more one-off transactions. And we do think, therefore, that valuations are not going to see a major impact because of the challenges that we've experienced in these few months as we get through the hardest parts of this pandemic.
And what is going on with public valuations?
So the publics sort of follow suit with that thinking. Interestingly, the publics certainly hit tremendous lows in the middle of March. In fact, their valuations, if you look at the Kerrigan Index, which tracks the 7 publicly traded auto retailers, that index hit 2012 levels mid-March. However, it has come back with a vengeance. It's now up 81% from those lows through the end of May, and actually has outperformed the S&P 500 by 25%. If you look at it, investors really are cluing into an important theme, which is auto retail very much outperformed the rest of the economy coming out of the Great Recession, and it is strongly expected that it will do so again. Looking back in the history and looking back at how we performed, you'll see that auto retail sales outperformed total retail sales by 35% in the years coming out of the 08-09 recession. And earnings at the average dealership grew at an incredible 30% compounded annual growth rate for 4 straight years after the Great Recession. Investors expect the same thing will happen this time, and it's not surprising because when you look at how low interest rates are now, our industry tends to do very well in a low interest rate environment. And because of everything the Federal Reserve has done to support the credit markets to ensure that consumers can buy a car and can get financed for a car, we do expect our industry to do very well, and obviously Wall Street investors think the same way.
Let's talk about dealership real estate. What are you seeing there?
So dealership real estate is one of the tricky ones, though, coming out of this recession. And many of you know that auto dealership real estate is the most valuable asset most dealers own. It tends to be more valuable than blue sky. It has more than doubled in value in our estimation since the 08 time period. Although we did start to see a slight decline in 2019 in estimated average dealership real estate value. Now, with the pandemic, the commercial real estate markets have been in somewhat of a free fall. The estimate is that the values have declined 10%, and the question is, how does that affect dealership real estate? If we see a tremendous amount of vacancies in commercial real estate, particularly retail real estate, that could be a depressant on dealership real estate as well. Now, the countervailing point to that is that at the very low interest rates that we see today, and with such low cost of capital, real estate investors tend to then bake that into their pricing, and that could be a counterbalance to the fact that we likely will see increases in vacancies in the commercial real estate market.
Any other trends you'd like to highlight?
Well, another trend that we write about in our first quarter Blue Sky report is that we expect buy-sell activity to not be the same across the United States as we come out of this economic shutdown. We think that certain markets will rebound much more quickly than others. If you look at states that were most impacted either by shutdowns or by the virus, those states, most of which are in the Northeast, are likely to see buy-sell activity come back more slowly than those states that did not see much of an impact in sales as a result of COVID-19. The ones where we expect to see the most activity are Florida, where we've been very active, did 4 transactions in the last few months in Florida, Texas, Tennessee, places like Idaho, Utah. Those markets were really not that affected by the pandemic and have seen their economies rebound more quickly than other places that really had a dramatic effect from this terrible disease.
Thank you so much for joining us, Erin. We look forward to talking with you again next month.
Bridget, thank you so much for having me, and I do wish everyone out there that they stay safe and healthy as we open this economy back up and get car sales going.
Thank you for watching the official news source of the retail automotive industry. This has been a JBF Business Media production.